Welcome to the end of the third quarter investment review and outlook. How are you?
I am doing very good, Ben. And how are you doing?
I'm good. Good. I like your new headset. Got on
Yeah,
this one.
hey, this is really cool. I've gone into the 21st century,
I like
and
it.
now I see that you've moved to the basement. Your wife must have kicked you out of your office.
It's
So,
a little quieter down there. Yeah, that's for sure. So sounds good. Well, today we're recording this on September 29th. So we got one more day before the end of the quarter. But we'll cover kind of what's happened so far this year in markets overall, and then kind of talk about, more importantly, what do we do going forward. Before I jump in on anything, you have anything you want to share up front?
oh boy, well, we live in interesting times, I guess, is it? And the election, which is really going to be a whole lot of fun or not fun for the next, 36 days or
Right.
whatever it is. And as we are speaking today, the first debate is going to happen tonight. Boy, is that going to be a free for all. I do not envy Chris Wallace trying to referee that.
Absolutely.
He's going to deserve a combat badge, I think, by the end of the evening, whichever side that you are on of that debate. But, I think economically, the stock market continues to forge ahead. I think it's a bit ahead of itself, and tech stocks, I think, are tech and biotech are definitely ahead of themselves. But, as we talked in the first one of these that we did here 3 months or so ago, all these bubbles always come to an end. There are no exceptions to them. I think the overall market is pretty fairly valued. I'm not worried about that. But boy, if you're in love with your Netflix and Amazon and so on, I think you ought to be awful, awful cautious, because markets have done this before and they never end well.
Mm-hmm. Yeah, and we don't know when that ending's going to be, but let's jump into some charts, just kind of highlighting what you just kind of went through. So the first chart I have up, because we all know I like my charts. The first one we have here is looking year to date at various different indices. So this is almost a complete 3 quarters, and we can see, in late March and April, you've got the drop on everything. I'll quickly run through what we're looking at. So the best performer so far this year, as you alluded to, is the NASDAQ. It's tech stocks here in the US, up almost 24% year to date. We've got gold is the next one on here, up about the same, about 24%. Then we get down to the S&P 500. That's a better measure of overall stock market, not just tech stocks. That's up just under 4%. Then right there, basically at zero, is the MSCI World, which is looking at both international and emerging markets, right at 0%. And then that's actually dropped for the year, down 9.5%, is the Russell 2000. That's small cap stocks. So these are U.S. companies, but they're smaller companies, and you can see they've actually gone down. So as you alluded to, Gary, a lot of news, a lot of stories, a lot of things have been said about the tech stocks and how well they've been doing, the Amazon and Microsoft and so on. That's only a very small part of the overall economy and overall stock market. As you can see, some things have done, obviously performed differently. Anything when you look at these numbers, you look at the chart here, that you want to point out?
Well, one thing I would say, if you take out gold, this chart, and if you switch the S&P 500 with the NASDAQ, this looks just about like 1999, when the S&P 500 was the only place to be invested. It was outperforming everything. And since I have been around for a while, I remember very well having conversations with clients that couldn't figure out why we only had, well, what I would have called a reasonable amount invested in the S&P, but not overweighted there, calling me and saying, Gary, what's wrong with you? Why don't we have a much, much bigger allocation to the S&P? And why are you in those stupid value stocks, those stupid small cap stocks? They're just yesterday's investments. I will only say they didn't say that 2 and 3 years later.
Yeah, and of course we're not predicting when things are going to switch. Just that this is not the first time this has happened, and
Yes,
you've seen it multiple times in the past on various different uh, ways to invest.
yep. I've always told people diversification works whether you want it to or not. And in 1999, people didn't want it to work because they still owned the stuff that wasn't doing well as some of what did well. But by being diversified, they weren't stuck with a whole portfolio that was horrible in 2001 and 2002. And because of that stuff that they hated in 98 and 99, did very well in '01 and '02. And at the end, you get to '03 and '04, clients came out really nicely.
Mm-hmm.
And it was simply because they were diversified.
Right. Yeah. Diversification. You're never going to get the best return. You're also never going to get the worst. So,
Bingo. And
that,
it's the best way to manage risk.
for sure. So let's take a look at one more chart before we kind of look to the future on what could happen, as I mentioned. So here what we've got is just the last 3 months. And the reason why I wanted to highlight this, these are the same 5 indices, the same 5 things to look at, is the narrative. If you read the news, it's tech stocks have done so well for so long. Now that is true, as we saw in the previous chart. They've done really well so far this year. But on this one, this is just looking basically here at the third quarter, and I think it tells a pretty different story. And of course, neither one of them is a perfect snapshot of what's actually happening in the economy and the market 3 months or year to date. But that being said, you can see that it's a lot smaller of a range. And actually here in the third quarter, pretty much everything is up a little bit. And so we've got the best, still is the NASDAQ, still is the tech stocks, up 10%. But the worst performer, as I'm not terribly surprised about, is the small cap stocks, but it's still up almost 5% here for the third quarter. So this is also, I think, good to look at different ways things perform over time, because it's not just the destination, where do we get to, but how do we get there and what happens in between. Part of it's rebalancing. We can rebalance and buy low, sell high, whatever has done really well. We sell a little bit, buy something else, but also just knowing we have multiple different asset classes that perform very differently from each other. Just pick any of these colors and you can see here on the chart how big the swings are, even just in 3 months that you have on here. So Gary, anything else to throw out here?
No, I think that pretty well shows what's going on this year.
Okay. Great. Well, as I said, we want to spend most of our time today thinking ahead, thinking about how do we allocate portfolios going forward in different scenarios. Neither one of us has a crystal ball. We don't think anybody knows what's going to happen, can accurately, precisely predict the future. That being said, we deal in probabilities. So it's all about different scenarios, different opportunities, different things that can happen, and different ways to then protect our clients, make sure they come out okay, kind of regardless of what happens. So Gary, you and I have talked about a kind of a barbell scenario of different things that could happen. Barbell thinking probabilities, high probability on one side, kind of a lower probability, lower likelihood of kind of a middle of the road, and a higher probability on the other side. Can you just lay out what we're talking about here?
Well, Depending upon what happens economically, and I'm speaking here, do we have inflation? Do we have deflation? Do we have an economy that really picks up speed and gets above where it was before the virus came along? Do we have an economy that the virus sticks around, for example, for a longer period of time, maybe around for a couple of more years? Nobody knows. Well, that's going to have a different economic impact than if the market, or if the virus goes away by the end of the year or the first quarter of next year, than if it stays around for 2 more years. And the way I look at what I call the barbell strategy is, again, it's based upon diversification, but I want to own assets since we don't know which way this is going to go. Therefore, we need to be prepared for it possibly going either way. And then, of course, we can adjust this as the signals are showing that it's going in one way or the other. But at this point, we have no idea which way it's going to go, much less the timing. So, what we call a barbell, let me give you a couple of examples of this, is what happens if inflation really picks up, which I think is a real possibility, not in the short term, but you look out 12 to 18 months further, I think there's a real possibility given the actions of our Federal Reserve, which we could have an entire 6-hour conversation
Yes.
about that, but we're not going to do that. But I think given what the Federal Reserve is doing, I think longer term, the odds of inflation ticking up, I think go up. Well, we want assets that benefit from inflation. These would be things like Treasury inflation protection securities that directly benefit from inflation going up. Gold is an asset that has no counterparty at all. Gold historically has benefited from higher inflation, and stocks tend to benefit from inflation as long as inflation does not go too high. If we had inflation go to double digits, heaven forbid go to 10, 12, 15%, that historically is not all that good for stocks. But if inflation went to 3, 4, 5%, that historically has generally been good for stocks. And real estate is another hard asset that tends to benefit from inflation because landlords or real estate owners are able to increase their rents at a higher rate, increase the income that they get from the real estate, and that pushes up the value of a real estate in a higher inflation scenario. The opposite of that is deflation, and deflation is basically where instead of prices going up, prices actually start to drop, which initially that sounds good if you're paying a little bit less at the grocery store to buy a loaf of bread and so on. That we like, but that normally means lower interest rates, normally means a real concern about a recession or a depression.
Mm-hmm.
So, that's not going to be good for TIPS bonds. It's not going to be good for gold or for real estate. So what do we have that generally tends to do well in a situation where we're not talking about negative increases, excuse me, we are talking about deflation here, in which prices go down, and generally in a time period like that. Bonds will tend to do fairly well because you get capital gains as interest rates drop. Although the income you'll get from those bonds will drop, and that's not good, but generally you can make up that or make more money because you get capital gains. The next thing, as long as we don't have too bad of a recession or, heaven forbid, a depression, stocks will tend to do okay in there. Now, they may be different industries that do better in a deflationary environment than do better in an inflationary environment. But if you're well diversified, as we are in stocks, stocks will do reasonably well, even in a deflationary environment, again, as long as that doesn't become too deflationary, and heaven forbid we have an extremely severe recession or a depression.
So if we talk about that a little bit more, both on the upside, which is inflation in terms of higher inflation, and also deflation on the other side, the closer to the middle, the closer to normal inflation levels, probably the safer stocks will tend to be. More likely you're going to get higher returns. But as you alluded to, if we have hyperinflation, if we have 1970s inflation, or on the flip side, if the Great Depression happens all over again, we have 1929 on deflation. Both of those probably are pretty bad for stocks, although the path to get there might be different. And then obviously on one side, we have gold and hard assets that do pretty well. On the other side, bonds, probably the safest investment you have at that point.
Right. I agree.
So with that, we've pretty much named everything that we have in a portfolio, and that is actually intentional because the reason that we put together portfolios for our clients the way that we do is not to predict which way this is going to go and say we're going to make a bet with all your money that this is going to happen one way or the other. As we've talked about this whole time, and anytime you've heard us talk about allocations, it's all about diversification, spreading out risk, and putting clients in a position to have the highest probability to make it through, come out unscathed, kind of regardless of what happens. There's no guarantees, of course, but to protect against different scenarios, but also not go hide and put all the money in cash at the same time, because there's obviously risk there as well. So with all of that, I think diversification just continues to play out in the way that we looked at things.
Yeah, and Ben, I would just add to that is that we have added one asset to the allocation, and that's gold. Because I had never invested in gold in all of my years as owning my firm, and that I just didn't see that as an asset class that I had an interest in. But given what has happened with the really change, well, it's not a change over the last 20 years, but the change in the Federal Reserve's actions here, that has led me to believe that we do have a greater possibility of an increase in inflation, and gold is an asset that I felt should be added to the portfolio as a diversification. Neither one of us are gold bugs. We only own gold where we think it adds. The biggest reason why I have wanted to add gold to your portfolio is simply as a matter of risk management, not because I thought we were going to make a ton of money in gold. Gold has done much better this year than I thought that it would.
Right.
And us putting money into it was not because we thought we were going to make for clients a ton of money, but as a risk management addition to the portfolio, that even though inflation hasn't played out yet, one of the reasons why gold has gone up is inflation expectations have gone up. and gold, of course, has benefited from that. But that is a new asset class that we did to better manage risk.
Absolutely. And even though gold is up, we both agree that now's not a time to take our profits and leave the asset class completely. There's a reason it's gone up, and that's because more and more people are seeing that there is a risk that things could happen with inflation, and especially with what the Fed has been doing. And so we want to continue to hold that in client portfolios. And maybe there could be a scenario we'd buy even more, even if prices go up, because we're not betting one way or the other. We're not saying we want to make double your money in it. It's more about having the proper protection in portfolios.
Absolutely.
So kind of as we wrap up, and you alluded to this earlier with the debate tonight, by the time people hear this, see this, the debate will already happen. So who knows what what will happen then.
I just worry about Chris Wallace's health.
That's fair. But I have gotten several client questions recently about, do we make any changes in anticipation for the election? And knowing the closer we get, the news is going to be all over, as it already is, about everything that could happen and what a different policy changes mean. What would your response be if a client called you up and said, we are worried about what's going to happen? What should we do?
Well, I think this is, again, it's all a part of the barbell strategy and why that we've structured it this way, because although it looks like Biden, he seems to be in the lead, although Clinton was in the lead 4 years ago, we really don't know what's going to happen. And I just can't see a reason for making a change based upon our concerns about what one candidate is going to do versus another candidate. I think all of us, that are watching this today, you're old enough to know that what promises a candidate makes in an election and in a debate is far from what actually happens once that candidate gets elected. Because if they have one of the legislative branches that's in the opposite party, they may absolutely want to do something, but they can't get it passed. Mm-hmm. And you have many other times that they support some thing, and the real fact is it sounds good to help get them elected, but once they're elected, they really don't particularly believe in it. And so they don't push it, and it may be something that you or I are very disappointed about because they decided not to emphasize that. But that happens all the time. And I would say the odds of that happening are greater with more of the topics that come up tonight than they are ones that come up and they say, I love this idea, and then they really push it once they get into the White House.
Absolutely. I think those are all good points. Other thing I'll add is just we are long-term investors, not short-term. And even if we sense some possibility of volatility as we get to the end of this year, it's all about what matters in the long run. Where's the overall economy going? Are companies making money that you as an owner can benefit from, being a stock owner, or bonds, or are municipalities able to pay their debts, things like that? That's what matters over long periods of time. The next couple months, we're going to stick with it. We're going to stick with a diversified portfolio and not make changes just because of what could happen here with an election and promises that may or may not be kept. Yeah. So anything else you want to end with?
We're running a marathon, not a 100-yard dash.
There you go. Perfect. Sounds good. Well, Gary, this kind of wraps up our third quarter investment review and outlook. Thanks for being a part of it again.
Great. Enjoyed it.